China stocks rallying this week as stimulus boosts investor optimism on the country's markets here. Now, if you want to play in the China trade without cashing into specific names, ETFs might be the way to go. As part of this week's ETF report brought to you by Invesco QQQ, we've got Todd Rosenbluth, who is the VettaFi head of research. Todd, great to have you back on the program here with us. All right, so I know you have been tracking the stimulus that has been thrust into the economy in China, and now investors are trying to figure out, okay, what is the trade that they should or could be initiating? On an ETF perspective, how does that play out?
So for much of the year, China has underperformed the broader emerging markets. And so investors actually had been gravitating towards these ex-China ETFs. There are ETFs that offer emerging market exposure, but strip out China. So iShares has a popular product, EMXC. State Street actually recently launched a ex-China ETF. But this China stimulus that we're talking about could be the necessary boost to get more investors focusing on China. The Chinese stock market did very well in the past month. So an ETF like GXC, that's the Spider S&P China ETF. That's a broad market exposure ETF. You have the opportunity to get China A shares. You get exposure to the broader Chinese stock market, industrials, financials, as well as the more growth-oriented sectors. And then KWEB, which is the Crane Shares ETF, the China Internet version that they have. And KWEB is targeted towards what you would imagine, the Alibabas, the Baidus, the Tencents, that are the well-known names, and many others that give you exposure to those faster growing companies in China. So we think many investors have been underexposed to China this year. Now is a great opportunity using ETFs, get the benefits of diversification to tap into some of those ETFs.